I've sort of challenged you a little bit on your sugar high comments, and I want to get to that. But let's just talk about what the job number and the unemployment rate indicates for the current state of the economy itself.
You know, Joe, relative to market expectation, the numbers are mixed. Payroll was not as bad, but you have the revisions. Critically, the unemployment number, and that's the number that's going to be on the front pages of all the newspapers tomorrow, has gone up quite a bit to 9.7. But if you step back and ask a more general question, which is not relative to expectation, but relative to what we need for sustained recovery, these are worrisome numbers. They're worrisome from the economic situation because without credit, employment and wages are key to sustained recovery. And what's that telling us is that employment is still a headwind, it's not a tailwind. Secondly, behavioral finance people will tell you that with unemployment at 9.7, probably going to 10, the employed become more cautious. So we have to worry about how the employed behave in terms of spending. And finally, let's not forget the political angle. That is a high number, and we have a system that's not built for sustaining high and prolonged unemployment. So when we put all that together, it suggests somewhat more qualified than what I heard Bob say about the recovery. I think what these numbers are telling you is we still have significant headwinds when it comes to the final handoff from stimulus to inventory to final demand. You need the final demand to kick in, and the employment number are telling you we're not there yet.
Mohamed? My dad was a physicist, and he would always say that it's a second derivative world, and if you understand that, you can do pretty well. If you look at the numbers over the last 9 months, first quarter minus 690, second quarter about minus 450. This looks like minus 250. You know, if you put a swizzle stick to that trajectory, at least in terms of the change in the change, it looks like you'll be flat in the fourth quarter, and you'll have job growth in the first. So it would be quite unlikely, in fact, it would have been unprecedented to go from minus 450 in the second quarter to job growth in the third. But if you look at the trajectory, I think it looked about as well as it could.
Bob, you could have a positive second derivative with a consistently negative first derivative. And ultimately, the first derivative is what's going to put money in people's pocket and what's going to get people to spend. So we need the first derivative to move. The move in the second derivative is a necessary condition, but not sufficient. So let's not get too focused on the second derivative. We also need the first derivative to move. And I think that that is critical. And the longer it takes for the first derivative to turn positive, the more the headwinds for sustained recovery.
But by historic standards, this is a better than average move from really ugly to moderate. And I'm saying, you know, what's your forecast for employment in the fourth quarter? Do you think it'll be minus 300? Are we going to deteriorate, or will the pronounced improvement that we've seen continue?
We're going to continue to see a less bad story, but overall, unemployment is going to continue to head above 2 and above 10%. And importantly, Bob, we don't have credit as the lubricant for recovery. So the recovery depends critically on wages, employment, wage rate. So remember, this is not a recovery where we can rely on credit to jumpstart the system. We really do need spending. And I think the Fed's minutes made it very clear that concern is starting to be very widespread, that unless the employment stabilizes.
I guess what I'm saying is, if you look at the employment data that we got this morning, if you look at the change in payrolls that we've seen over the last 9 months, the trajectory suggests that we're going to get there.
It's when we get there, right? It's a little bit like me telling my daughter, yes, we're going to ultimately get there, okay? But it's going to take much longer. She's going to react very differently.
To me, you sound like my son in the back seat saying, are we there yet? And, you know, you have to have a little patience.
Oh, you have to have a little patience, but you have to look at what's been priced into markets and ask, is that consistent with patience or not?
Well, that's where we're going to get back to the sugar high stuff, because I look at your notes, and it kind of seems like you're trying to take a victory lap for that comment. 9,300 on the Dow and 1,000 on the S&P. You are not right yet. You are waiting for Godot on your sugar high for the markets to somehow reflect that it's not justified by the current backdrop, Mohamed. So we're going to watch, and we're going to hold you to that. And when I ask you about why you know that it's looking out 9 months, you gave me a very good prediction, your prediction of what how you see the economy. You're not saying that the market's ahead of itself based on current economic backdrop, but you're not that bullish a year from now about the economy.
Correct, Joe. This is about 2010. 2009 is clear. We're going to have a nice bounce that's going to be the combination of the stimulus and the inventory cycle. The reason why I'm calling it a sugar high is because both the stimulus and the inventory cycle are temporary events. They're not permanent events. So you need something more permanent to kick in. So 2010 is all about whether the final components of demand kick in. And the concern we have is about 2010.
Right, but we talked about earlier on the show that the averages are below where they were 11 years ago, Mohamed, and there's a reason for that, and maybe it's the situation, the forecast you're describing that justifies where the markets went, but they aren't necessarily ahead of themselves now.
Yeah, I think if you look at what's priced in for earnings, what's priced in for defaults in the credit markets, the concern is that that price is in a sustained recovery. That price is in a pickup in net earnings, not from the cost side, not by cutting costs, which has been very successful, by generating revenue. And if you're going to generate revenue, you need demand. You need someone to sell to. You need a final element of demand. And that's going to be what's going to play out. And it's going to be fascinating to watch whether we do get that final handoff in time to justify current valuations.
I like when you step out into the stock forecast. You know, and Bill did that once, gross, and it eventually worked for him. It took about 3 or 4 years when he said 5,000 for the Dow, but it eventually worked. But I like when you do that. You translate all of your economic savvy into where the averages are. But we'll see. We'll see who comes out right. But I commend you on your courage.
Joe, I got to remind you that we manage for clients products that have a very high equity element in them.
Oh, right? No. You'd much rather see the bond market go up on your car. I know that's where your bread is buttered. Hey, the Bengals won last night too. I think they beat the Pats too at some point, didn't they, Mohamed?
I can't possibly comment on the Pats because you're going to get my former colleagues all upset. So let's just focus on the Jets beating the Eagles.
Mohamed, thank you. And we want you back in studio. I think I missed you last time again, but look forward to seeing you.
And Joe, who comes back from holiday the day before Labor Day weekend?
Kidneys. Right?
Seasonally adjusted, he's still in Georgia.
Yeah, exactly. I need a 3-day weekend. I'm exhausted. Thanks, Mohamed.
Thank you.